Welcome back to another episode of the Kansas City Commercial Real Estate Market Pulse. I'm your host, Logan Freeman, and I have the great honor to introduce everyone in my network. If you don't already know him, Bryce Richardson. I'll give him a bio here in just a second, but to set the table here, we are talking about Central Arkansas multifamily, and we are going to do a deep dive into localized market dynamics, the insulation strategies that Bryce sees investors utilizing today, and the small market thesis. Look, guys, I do a lot of work in small towns all across Missouri and Kansas, and I've had the pleasure of getting to know Bryce over the last couple of years through the Brokers Mastermind, become good friends, and now we're doing deals together. So I'm excited to introduce Bryce here in a moment, but we're going to talk through the statewide snapshots. We're going to annualize some localized transactions and really get into the nitty-gritty on why evaluating secondary and tertiary markets gives you risk-adjusted returns if done right. Gabe Einhorn's always showing up saying, here we go. Appreciate your support, Gabe. You are all over the place on LinkedIn. And Lauren Brychell says that understanding the operational upside and local demand drivers is essential when evaluating multifamily opportunities across emerging markets. Tell me that's not AI, but thank you anyways. Lauren, I appreciate you for the comment, and thanks for being here. So if you guys have questions for Bryce or myself, as we are live here on LinkedIn, drop them down into the comment section. Let me introduce my wonderful co-host here today, Bryce Richardson. So Bryce is the president of commercial sales at Brick Real Estate and one of the Central and Southern Arkansas's most active commercial real estate brokers. He's based in Conway, Arkansas. Bryce specializes in investment sales, in commercial leasing, and asset management across a market footprint that spans from Harrison in the north to Texarkana in the south. That's amazing. Covering the full arc of Central and Southern Arkansas that institutional brokers routinely underserved. But his primary focus is the greater Little Rock metropolitan area, including Little Rock, North Little Rock, Conway, Sherwood. How do I say this one? Maumelle, I got it right. Maumelle, Cabo, just like the wine, Jacksonville, Benton, and Bryant. These are all markets that are anchored by state government, healthcare systems, and military installations. And they have a network of regional universities. So Bryce is maintaining an equally deep presence in Arkansas's secondary and emerging markets, okay? And he's built his practice around the commercial asset classes that define the Arkansas investment landscape. That's multifamily, retail, industrial, mixed-use properties in markets ranging from the suburban Little Rock metro to small college towns and agricultural economy communities. So, Bryce, I appreciate you spending some time here today. Welcome to the Kansas City Commercial Real Estate Market Pulse. I can't believe it's taken us this long to get you here, but we've got a lot to dive in today, man. How's your week been going? How are you doing?
Yeah, Logan, I've learned from the best, aka Logan Freeman, the leader of the Brokers Mastermind. Upon joining probably, 12 to 18 months ago, the business has boomed. So weekly now is more not just managing deals, but managing teams. Logan's helped me scale where we were to where we are now. So week by week is driven by the chaos of each deal. And yeah, we're very excited to talk about one, Arkansas as a whole, two, the multifamily market specifically, and dive into a little teasers on what's coming with the listings we're going to discuss.
Absolutely, man. I mean, you cover Central Arkansas almost exclusively and, deliberately exclude and don't really go into, and you can keep me honest here, Northwest Arkansas as much as some of those larger brokerages. So I love the niche, right? So walk me through how those two markets differ, Central Arkansas, Northwest Arkansas, from an investment standpoint, and why that distinction matters for people coming in from out of state.
Yeah, so I think that everyone from a national perspective always looks at the headlines to pursue investment. So if you want to pay attention or have heard anything about Arkansas, more than likely it's had something to do with the key companies in the state. So just to name a few, Walmart, maybe you've seen them on a side of the road, right? Banco ZK, one of the largest commercial real estate construction loan providers. Tyson Foods, if you've ever been in a Walmart, or Harps or Whole Foods, you might have seen some chicken in the frozen section, right? I'm sure anyone that's read or watched any type of news has heard of Lockheed Market, Raytheon, and those defense manufacturers. Anyone that's been to a mall has probably seen Dillard's, and anyone that has anything to do with supply chain has probably heard of JB Hunt. So most of these organizations either HQ in Arkansas or have a very strong presence.
Yeah, it's a good point, and I've spent a lot of time in Arkansas. Love Arkansas. It's beautiful, beautiful state just south of us here in Missouri. So you just are our neighbors down to the south. Now, look, I want you to give everyone kind of a snapshot, okay? Give folks an idea of the population, of income, right? What are people thinking about when they say, well, I'm going to go to Central Arkansas? What is that small market thesis? Let's set the stage here for everyone.
Yeah, so if you don't know the data of Arkansas as a state, I believe that commercial real estate and real estate in general is driven by mainly three things. One is population, two is economic drivers, and three is obviously the development and income of a city and an individual. So what that looks like on a broader basis is we currently have 3.1 million people, plus or minus some, right? We're going to go very broad. I'm not going to give you specifics when it comes to some of this data, but I'm going to give you the most updated data I have just to preface with that. But 3.1 million people across the state. We have one city above 100K people.
Wow.
So one city, you hear Northwest Arkansas, we have large greater metro areas.
Sure.
Specifically within Central Arkansas, Northwest Arkansas, Northeast Arkansas, and Texarkana, right? Those are really the four markets that we have that are greater than 100,000 people. And that ranges from 300,000 in Northeast Arkansas to roughly 700,000 in Northwest. And we're slightly above that within the Central Arkansas area. So Central Arkansas is the largest metropolitan area within the state, specifically around the capital, right? What that means is the economic drivers are generally driven by those four markets.
Yeah.
Right? Each one have their own specialization within the market. Northwest, which is what everyone has heard of, right? That is Walmart's HQ. It was started in a small town of, I think it was like 15, 20,000 people many, many years ago, Bentonville, Arkansas.
Oh, yeah.
That is now scaled. And because of some of the strategic economic things Walmart has done, I heard recently that they are highly encouraging any vendor of Walmart to enter into the market, right? So there's a huge inflow of tenants that work with Walmart, flooding that market. When it comes to the Central Arkansas region specifically, we have a large data center presence starting to open up. Logan, I'm sure, has some thoughts around that. I think the announcement was about $8 billion so far this year, plus a little bit last year.
It's impressive.
For us, probably 7 to 8 centers. So it's a smaller number, but for the state like us, it's a huge economic impact that'll increase our already strong blue collar workforce. And our median income is right around $70,000 a year, right? So now some people in some markets might think, oh, 70, that's not very high, right? But when your average median home is $230,000, that's actually pretty good.
Yeah, it's really good.
Right?
Yeah.
People here aren't necessarily strapped to the extent that they are in other markets. And what that means, and I've looked at some population data provided by CoStar's reports recently, and most of our driven population growth is actually through domestic migration.
Okay.
So all of the flight occurring on the coast, we're getting a portion of that, right? And a lot of people are starting to see, hey, I can own a couple acres of land and pay $300,000 for a house for 5 acres. Man, that's pretty nice, right? And then
you ain't getting that in Kansas City, I'll tell you that much.
No. And Arkansas is a very unique market, and there's a lot of things that are being done within the political region that is driving a lot of economic drivers into the state.
Absolutely, man. Let's talk about the traded volume, right? Because I think investors, when they start to evaluate the small market thesis that we're going to get into here shortly, they sometimes worry about exit strategy, right? And so, like, what does that look like from a multifamily trade volume on a regular basis for your guys' market?
Absolutely. So we'll talk about the number of buildings, specifically multifamily, since that's the topic today. Throughout the state, we roughly have 5,000 multifamily properties. Not too much, right? If I were to draw a 50-mile circle around Little Rock, where it's about 25,000 or 2,500,
Okay.
right? So across the entire market, we trade about 4% annually, right? So Northwest Arkansas, Northeast Arkansas, and kind of the coast that I touch sometimes, but not very often, that makes up for close to 50% of the trades.
Okay.
Whereas the other 50% are constrained within that 50-mile radius. So what that looks like specifically is across the state, we're seeing about 200 trades per year.
Mm.
Volume is actually increasing. We'll go into why a little later, but within the central Arkansas market, we have about 70 that have traded in the past 12 months. So around that 2,500, so that's roughly 3% that we've seen trade specifically on multifamily.
Wow. Okay. Yeah, that's really interesting. So, what is the strategy when folks are evaluating, Central Arkansas? Let's talk through the small market thesis. And while you're doing that, I'm going to pull up, how many properties are statewide. Well, I'm actually just going to pull up Kansas City, Missouri, MSA on the multifamily, just to give everybody some context. There's 5,000 properties statewide in Arkansas. I'm going to blow your mind here in just a moment.
Yeah. So let's just talk about Arkansas's footprint. There is roughly about 500 cities in the state, right? Over 90% of that, I think it's 490, are actually smaller than 20,000 population.
Okay.
Right. So when we look at what that means for investment theses, that means that there may be fewer properties in smaller markets that can actually allow an investor to own a larger portion of the entire market. So I think of it like a pie, right? We know that, if we're looking at a stock, you own percentages of the total volume traded, right? Well, in Arkansas, in these small markets, if the total volume is 100% and there's 100 units in one purchase, you can own 20% of the entire market.
Yeah. Yeah.
Right. So when it comes to yields, we're seeing a lot of C and B class trading on a sales perspective, but we're actually seeing a lot of absorption move to class A within the larger metros. So I'm sure you're probably seeing something similar in your market, Logan.
Yeah.
Or would you say it's different?
No, I mean, and just to give everybody context, so Missouri has 10,000 multifamily properties. We add Kansas in there, we get up to 12,919 properties, most of those being on the state line around Kansas City, Missouri. So just almost 3x the amount of multifamily properties in Kansas and Missouri versus Arkansas. Look, I mean, there's the way that I evaluate this, and we've done projects in Hutchinson, Kansas, and Holton, Kansas, and all of these different components of those areas. And we have investors who obviously want to be in the main corridors of the Kansas City MSA. However, we oftentimes get investors that have allocation to bigger metropolitan statistical areas, and they start to see basis between $50,000 and $75,000 a unit, and they're coming from California, and to buy one unit is $400,000, $500,000 out there. They can buy a 10-unit apartment complex, a 20-unit apartment complex for the same price, if not cheaper, and they're looking at the cash flows also from a diversification standpoint. So I think that's what the small market thesis really kind of brings for individuals, is a part of your portfolio can be in these cash flowing types of areas. The other component that I will just say on the supply and demand side, like, you're never really worried in these smaller markets about a bunch more supply coming online and rents being squeezed, right?
Yep.
And so if you track the demographics and psychographics of renters, specifically across the asset or the ages that are becoming that age of renters, they kind of typically like to rent for a period of time, so there's strong tailwinds on that front. In regards to what we're seeing, it's like, look, man, the Class A stuff, even in Kansas City, people are being priced out of. Like, they're looking at what they're getting, and they're saying, well, that's a great opportunity to live downtown or in that corridor. But I mean, we're pushing rents that are $1,800, $2,200, $2,500, $3,000 a month. And I just saw this week that San Francisco and New York City both eclipsed $6,000 per month for rent, right? Like, so I guess it becomes like, if you think about the median income of $70,000 per year, and then you see the portion that has to be allocated towards rent for a small market thesis versus owning a property in one of those gateway markets, it becomes very clear what that opportunity is, right? And then you look at the supply and demand fundamentals. And if there is a recession or people they feel less wealthy because the stock market goes down, they're going to start looking for more attainable, affordable housing opportunities, right? And so we see that exact trend here in Kansas City. I will tell you that, like, it is highly driven here by schools, right? So like, people really want to be in specific school districts, but it's hard to build. It is hard to build multifamily in Kansas City. It's hard for land prices. It's hard because of the public policy around permits, and not to mention trying to find construction, and the material costs and labor costs, all of that. And so, I think that what we've seen is these 80s, 90s, early 2000s products really shining, Class B, not highly amenitized, safe, clean, affordable opportunities for people to live, right? And I love transitional housing, meaning if you're a first-time renter, you're probably not going to that Class A building that you have to have somebody co-sign because you can't afford $2,500, $3,000 a month. You're going to go build your credit up and get, really good, reputation of being able to pay your rent. And you do that when things are $800 to $1,500 per month. And that's feasible for a lot of people.
Yeah, I agree. And I would even, just to give a snapshot of specifically my city when it comes to product and prices, right? I've sold a couple properties and worked on a couple properties within my city, and they just turned on a couple of new Class A properties, right? So the average rent for a Class B, Class C property within my area for a 1 to 2 bedroom, or 1 bedroom around $750, $800 a month. For a 2 bedroom, $950. Well, Class A's entered the market, first amenity-based properties, very high Class A, marble slabbed pools, movie theaters, all the amenity you can think, pickleball courts, right?
I just saw cold plunges and saunas, and all of the things.
I would love to hear your guess on what you think the 1 bedroom rent is on that property. Take one guess, Logan. What do you think?
God, I have no idea. 1 bedroom, Class A building, $1,800.
About $1,150 to $1,200.
See, that's unreal.
So if you really think about it and look at the median income, right, of $70,000, that's roughly about less than 30% of your monthly expenses.
Yeah.
Right, which is unheard of right now. The national average is 40 to 50 to 60% in the larger coastal markets.
So average effective rents in Little Rock around $1,039 per month. Occupancy is right at 90%. What does the picture look like in the markets where we've got these 3 properties that we're bringing to market at? So when we look at those 3 properties, Park Apartments in Monticello, we got some apartments in Batesville, and the Warren Apartments. Those are all kind of secondary or tertiary Arkansas markets. I mean, how do you think that operators are seeing occupancy, workforce housing product relatively to that market? Like, let's talk about those 3 different markets, and we'll come back to some other questions we've got in on the general Arkansas theme. But I do want to kind of walk through Batesville, Warren, and Monticello.
Yeah. So across the 3 cities, the total population is close to about 26,000.
Yeah.
Across all 3, right? So we'll work on one and then go to the other. So
okay,
let's start with Batesville specifically. 12,000 people are in that city, right? Of that 12,000, there is only roughly 700 multifamily units, right? So of that, only 25 properties. So for the total percentage of that, there's only 5.8% of the total living supply that is multifamily.
Okay.
right, across that 700 units. So within that, the vacancy of those units is 4%, right? So that's very strong vacancy percentage. Most of the time, the bank's underwrite at 5-6.
Yep.
Right. So it's a very strong thing. What's going on in the city? What is getting people paid to afford that? Right, is roughly healthcare, manufacturing, and education.
Yep.
There's a college or two, and they have various manufacturing companies that are driving a lot of the revenue in these cities. And if you've watched any headline recently, there's a lot of manufacturing push across the country. So what I'm seeing on a local basis, at least from our current administration within our state, is they're actually incentivizing a lot of existing manufacturers to stay where they are. So they've got creative programs to allow for investment into their businesses.
Mm.
And they're also creating various types of opportunities for new businesses to enter the state into these similar markets.
Yeah.
Right. So if there's a manufacturing facility within one of these cities in Arkansas, the possibility of a new one entering based on the programs that exist right now is higher. So that's really what's driving the Batesville economic market. And if we look at, total 700 units, let's just say that a property is 70 units, you would own 10% of the rental market.
Right.
That's crazy.
Yeah, it is.
Big piece, small pie.
Yeah, absolutely. 100%. I got to imagine there's not, 200 units under construction right now either.
No.
So you touched on the stickiness of the corporations and the businesses that are in those areas driving the folks that are living in those. Not to mention, there's probably more and more jobs coming to Arkansas in a big way. They're going to need places to live, and, we get a lot of questions around, data centers and bringing jobs. Okay. But even if it's a 2 to 3 year period, if you're a multifamily operator, you are set up to capitalize because you have the product that they need for 2 to 3 years. Right. So there is benefits to that. Now, I know on Batesville specifically, utility structure is a big NOI lever. And specifically, part of it when a building is master metered, right? So let's talk through some of these, uniquenesses and how common is the ratio utility billing system or individual metering transition in smaller Arkansas markets. I know in Kansas City, it varies case by case, but a lot of our properties that were developed in specific vintage times and areas, they do have master meters, right? And so when you think about, and I know you are very active in leasing apartment units as well, your company is, how oftentimes do you see the opportunity to say, well, we're going to be passing along some of those costs to our tenants?
Yeah. So I'll give a short background on answer your question. When I first got into multifamily sales about roughly 2 years ago, I wanted to understand the operations of a multifamily property. So what I did to do that is I said, hey, what is no other multifamily broker doing? I doubt they're calling the owner and saying, hey, do you have vacancy? I'll lease it for you.
Yep.
So within a 6-month period of me starting multifamily, I called roughly 100, 200, 300 owners, and 20 properties said, yeah, we will let you lease our vacancies. So within that 6-month period, I leased 150 apartment units.
Wow.
And I understood the way to market them. I understood the things that tenants looked at to decide on an apartment complex that they would move forward on. And I did it across roughly 4 different markets within the state. So it wasn't just one city. It wasn't just one market. I got to see how it acted across multiple. So to go to your question, Logan, tenants love simple payment structures.
Yeah.
Right. If you can put one portal, one payment, tenants would rather pay a little bit more for the ease than having to manage 4 or 5 different bills across the utility provider, the other things. So these legacy properties specifically, I'm dealing with one right now that it is a master meter and they're not charging back the utilities. So they've transitioned into a RUB system and they're starting to basically implement into their monthly ledger sent to the tenant that utility bill. So master meter, if it is a property that is not currently using a REP system, is actually a value add opportunity for a secondary owner.
Absolutely.
If he purchases it, he can transition the REP system and then pass that cost to the tenant who's already paying below, market rent compared to most other markets. And that's less expense to the owner and more ease for the tenant.
Hey, I see a lot of people live here. If you got questions for Bryce, myself, about Arkansas multifamily, drop them down into the chat. We are monitoring those. Bryce is dropping a lot of knowledge, not only on Arkansas multifamily, statewide economics, but also value levers you can pull specifically on 3 different properties that he and I are working on together. So moving over to Monticello, the Park Apartments in Monticello, that's a 64 unit apartment community, and it's got a heavy 3-bedroom concentration, right? Like I think 32 out of 64 of those units are 3-bedroom. That's unusual for most markets. In Monticello specifically, let's talk through that 3-bedroom product being able to perform better, equal, or worse of these 2-bedroom and 1-bedroom from a collections and rent retention standpoint. How do you think about 3-bedroom units?
Logan, I love them. I love 3 and 2-bedroom apartment complexes because they are so much easier to lease.
Yeah.
Right. So I'll reference a CoStar report. And if you would like me to send this is a 2026 Q1 CoStar Central Arkansas multifamily report. And in that report, it showed that 1-bedrooms are actually people overbuilt the 1-beds, tried to push the rent, and they couldn't fill them. So the vacancy on the 1-bed apartment complexes are actually way higher than the Central Arkansas typical vacancy within an apartment complex. So when you have 2 to 3 bedrooms that are dominating a property, that opens up opportunity for families. It opens up opportunities for roommates and cost splitting opportunities for the tenant base.
Absolutely.
Right. So I'm a very big advocate. Anytime somebody sends me a property with larger, 2 to 3 bedroom unit counts, I'm heavily looking at, hey, how do we, leverage the existing market? So within Batesville, is there a strong pull from the university students to have 2-3 roommates? And what could they afford to split that rent by? And is there a rent push opportunity?
Absolutely.
Alongside of a family that could also just need more space at a more affordable price.
And what I'm hearing from you is, there is, in the smaller markets, there's a lot more nuance in understanding the product type and what drives the value levers that you can pull, but what tenants and, residents are actually asking for. And you're sitting right at the confluence of all those different components. So look, guys, we've got 3 different properties in Central Arkansas, Batesville, Warren, and Monticello. It's 141 units. Reach out to Bryce if you are interested in learning more about those. He's got all of the information that you will need, got the CoStar report from a market reporting standpoint, but you're going to want to speak to him about the opportunities and each one being specifically different. Let's talk about Warren Apartments, man. That deal is at 94%. For a market that size, is 94% genuinely stabilized, or is that kind of top of what that city and that market can sustain long term? We talked about, vacancy over in Batesville being 4%, underwriters doing 5 to 6. This is sitting right around 6%. So do you see an opportunity to this be 98, 99% occupied, or is 94% usually, in this market pretty standard?
I think it's probably pretty standard, but anytime I see something that hits the standard, there's always a marketing play to increase it. Right. So for me, as an operations person that pulls from my leasing experience, whenever I see something is sitting vacant for longer than it should be, my question would be, what are they doing to fill it?
Yeah.
Is it just a sign in the yard? Is it a Zillow posting? I actually, on Warren specifically, pulled up Zillow, which is what everybody kind of looks at in Arkansas. Apartments.com is blown up in some of the larger metros, but these smaller markets are still Zillow driven for rent. And there's actually like 2 properties listed for rent. So, okay, are you using a sign? Well, why don't you throw it on Zillow?
Right.
Right?
It's not even on there.
Yeah, it's not even on there. So for me, on the, hey, is it average? The answer I would say is yes for the market. But my question would be, hey, how are they marketing it to the extent that they could?
Yeah, absolutely.
So,
Great points there, Bryce. We got a listener question. And if you were advising an out-of-state buyer on what due diligence items are non-negotiable before closing any of these 3 assets, what would be on that list that an out-of-state buyer would not think to check?
yeah, I think I would always right now check the plumbing systems. Because if there is cast iron, I'm seeing this specifically in the central market, more Little Rock. I'm not sure exactly how the builders in Warren and Monticello did it, but there's a lot of cast iron things that are worth scoping prior to any type of escrow going hard, would be my encouragement.
Yeah, that's a good point. I think that you have to always understand mechanical, electrical, plumbing, right, on these assets. We got another question in. From a financing standpoint, what loan products are actually available and closing on secondary Arkansas multifamily right now? Is it primary local banks or agency products accessible on deals these size? What are you seeing in the marketplace?
I think that if you looked at the portfolio, you would have a larger financing realm available. I think if you're looking at an individual property, you would probably want to target more local banks, because within the state, and Logan, I'm curious if you're experiencing this as well, with the rates continuing to be a little harder and the market maybe being a little slower in the residential side, banks are actually looking for more loan opportunities. So they'll be more aggressive on opportunities for out-of-state investors.
Yeah. I think it's very borrower driven right now.
Correct.
Right. So, we hear global cash flows quite a bit from lenders, so if you are a strong operator and you have a good balance sheet, you have a good cash position, you've shown that you can operate in these smaller markets, your options are going to be much more vast than if this might be your first time. You may have to really build a relationship with a local or regional bank to come in here and look at these asset classes. If you need financing solutions and you want them to start underwriting some of these deals, Bryce has got all the lenders that you need to talk to about that. I did a little research, and good old AI is telling us that builders did not stop using cast iron for multifamily and residential plumbing on a single exact year. Instead, there was a gradual transition occurring between the mid-1970s and the early 1980s. And that's when, PVC and ABS largely replaced cast iron for drain, waste, and vent systems. So talk to the listeners about the vintage of these properties and the likelihood that cast iron is here.
Yeah, I think that on a few of them, there is a possibility that cast iron is here, but I believe one of them, Logan, I don't have the age and vintage in front of me on it, but one of them is in the 80s or 90s. So it probably would not be a problem.
Yeah, definitely something to check into from a due diligence standpoint. That's pretty typical, doing sewer scopes on all of these properties during your due diligence period. So if that's, needed, we absolutely can get that done, obviously. All right. So we've kind of talked about, Arkansas as a whole, Central Arkansas multifamily. I think we've covered that extremely well. Again, 141 unit Central Arkansas portfolio here, Batesville, Warren, and Monticello. Reach out to myself or Bryce for more information on that. We are going to be hitting the market here, I don't know, in the next week or so, just gathering as much information from the ownership group as we possibly can right now. So let's go on to a couple other things. Bottom line investor takeaways for Central Arkansas and small Arkansas markets, right? We've talked that, well, we haven't really talked about the actual asset class having in the location having a higher cap rate, right? So let's talk about what investors are really asking for in these tertiary and secondary markets from a cap rate standpoint versus you come to Kansas City and it's 5.6% if you're lucky. So let's talk a little bit about cap rates and rates of returns.
Yeah, so from a cap rate perspective, each specific town is different based on the recent trades. The research I've done on these three is it ranges between 7 and 8 cap. from an NOI basis. On a cash on cash basis, it really just depends on what type of purchaser you are.
Yeah.
I believe one of these properties has some value add opportunity, which may require a little CapEx, which could impact your cash on cash. But for the other two, mostly they've been somewhat renovated, and it would be more of a purchase at a lower cap rate in a higher cash on cash play.
That's right.
So I think that for those two, it's more of an operational value add than it is more of a CapEx value add. So for you specifically, I think you would have an increased cash on cash opportunity within the portfolio compared to probably what you're seeing in Kansas City and, Texas and Nashville.
Yeah, I mean, we see this in the smaller markets in Kansas and Missouri that we work on, typically 100, 150 basis points over the national spread in the major MSAs. Yeah, you get out to California, we're talking 4 caps still, right? I mean, I saw some guys just sold some properties out in California, 4.84% cap rate, right? So these markets, if you get comfortable understanding the demand drivers and understanding the operations side, you can really get a higher yield on your money. But you have to think about your exit strategy and who you're going to trade to. And, it's probably a long-term perspective here, right? It's a cash flow perspective. So if you're an out-of-state investor, you're not in the Midwest, and you're looking to get into Midwest, this is a great opportunity. I've helped 5-6 investors over the last 12 to 24 months reposition a certain amount of capital into smaller markets. And, I check in on them. I'm saying, hey, how's your property going? And they're like, dude, we can't stay, we're occupied. We can't get another unit. We honestly can't even raise the rents because nobody's moving out. We don't want to kick them out. I'm like, look, that's a good problem to have. Your value add plan may be pushed down the road a bit, but you bought at a good DSCR, you're cash flowing, it's no worries, and it's staying occupied. And frankly, if you do build relationship with your residents, being able to add some value to the property, clean up the parking lots, right? The trash receptacles, get some more lighting, paint these dang things, give them some LVP in the apartments, replace that old carpet. Then you start hitting with on your renewals, 25, 50, $75. That's an opportunity. Also, we've talked about ratio utility billing system opportunity to really pull some value add here on these deals. So we've covered the low risk of, new competitive supply. One thing that we've talked through, but I can't state high enough, is the durable local employment base. Okay. And I think this is probably the biggest disconnect from people that don't invest in the Midwest or, Southern Midwest. I don't even know what you call Arkansas. Is that the South?
Yeah, we call it the South.
Okay.
Yeah.
So it's the South. I sort of agree with that, but, being able to drive to Arkansas in 2.5 hours, it's like, well, this feels very.
You're basically in the Midwest.
It very much feels like home. Now we get down to Southern Arkansas, it's a little bit different.
It's a little bit different.
Same thing in Cape Girardeau or down to Southeast Missouri. It's a little bit different down there. But you have to think about the durable local employment bases, the low risk of new competitive supply, and we have harped on the affordability supporting this rental resilience, right? And so I think the combination of those three things produce a stronger risk-adjusted cash flow return than typically people see in oversaturated or amenity war, like we talked about, Class A metros. I couldn't believe it. I saw a new post on LinkedIn. Group does a great job putting their product out there. I mean, dude, they have a cold plunge at the apartment complex. They have a cold plunge, a sauna, dog washing station, pickleball courts. They may even have a nail salon in there, man. I don't know, but wow, that's, you got to believe, even if you get a couple months free rent, once that renewal comes, I know for a fact that my sister lives in one of those apartment complexes. Every single time that the renewal comes up, it's $200, $300 more. It's so you just have to keep that in mind as you're thinking about this. Okay. So Bryce, what have we not touched on today about Arkansas multifamily? We're teasing out this portfolio. We'll come back live when we have everything ready to go through them deal by deal and answer questions. But in regards to general thesis around smaller markets and Arkansas multifamily, is there anything else that you wanted to really talk about?
Yeah, I think that the biggest takeaway for the listeners is that if you're looking at stronger returns, lower bases, and more opportunity to focus on operational value add, this could be a great opportunity for you.
Absolutely, man. 100%. Now, my favorite session, and I don't have a slide of it, it's a quick takes with Bryce. Okay. So if you want to reach out to Bryce, I didn't check your phone number, brother, but I hope that is your phone number.
That's the phone number, personal cell.
So you got the cell phone there. Bryce at brycerichardson.com. You can find him on LinkedIn. You can find him on the internet very easily. Reach out to Bryce and his growing team. All right, man. What's your favorite book or podcast that you're listening to right now?
I would say the Kansas City Market Pulse.
Nah, I can't use that one.
I can't use that one. I love the All In podcast.
That's a great podcast.
Anything that allows me to see a greater economic understanding and populate, anything that ties into kind of the demographic, psychographic, economic driver of the country allows me to best advise. And because I have an understanding and network of the local footprint, so I can say, okay, if this situation is occurring within the nation, this is probably how it would affect the market and how it would increase certain things.
Yeah, right? Most definitely, man.
As far as my favorite book, I would say How to Influence and Influence People is one of them. You can't go wrong with that book. And then one that I find fascinating, it's a love-hate relationship with certain people, is the book called The 48 Laws of Power.
Oh, yeah. Yeah, Robert Greene.
Yep. Very fascinating book. Not in the context of manipulation. I read it in the context of how to not be manipulated.
Yeah, yeah. I mean, I was thinking about this last night, Bryce, and yes, we're in the real estate business, but we are in the information and relationship business. And I was having a call with the big group, taking industrial buildings, turn them into edge AI, inference, whole location facilities. Okay. If you don't know what that means, go watch 5 or 6 of the episodes we have here about data centers or reach out to me. And, they said, man, you really articulate well on what you're communicating. And I said, well, it was all about Toastmasters early on. And it was about, figuring out how to get the ideas out of my head in a clear, concise, and compelling way and communicating. And I think that's like a very big skill set for anybody in marketing, in sales, and in brokerage, because that's our job, right? And so the better that you get at communicating, the better you're going to have on your results with your clients and when you're talking to buyers. Like, everybody sees offering memorandums, and until you actually speak with the person that is working on that project, you may not understand exactly the differences between Monticello and Batesville and all the different components, right? But you get on a call with yourself, they're going to really understand that after the next 30 minutes. Okay. So can't agree more. Robert Greene. I will just add, I really like 50 Cent. I'm a big 50 Cent fan. So Get Rich or Die Trying is still one of my favorite albums, so if I have a tough day going on, I just put that bad boy on and we're just rocking and rolling. Long story short, he wrote a book called The 50th Law as well, with 50 Cent. And I don't know if you knew that or not, but it is really cool and a great story as well. So check that out. Another question that we've got for you, Bryce, if you weren't doing commercial real estate, what would you be doing?
Well, I actually came from AI data center hardware sales.
Yeah.
So I did real estate and politics through college. I moved to Nashville, Tennessee, and then I did AI and hardware sales, and I sold into large organizations, the network, server, compute infrastructure that Logan basically is working around. So what got me actually back into commercial real estate was, hey, how do I try to wiggle into the data center world? I know
100%.
I know the infrastructure. How do I figure out the real estate? And that's kind of what brought me back.
Absolutely. Well, point people in the right direction. I know we've got your phone number and your email address here, but if they want to follow you, they want to get more information about Arkansas multifamily, maybe get on your list so they can be in the know when you're listing these new apartments, where do they go?
I would say check out my LinkedIn. And you just go to LinkedIn, type in Bryce Richardson, Arkansas. I'm pretty much the only guy on LinkedIn with that name doing real estate in Arkansas. And you can connect with me, DM me, and we are happy to set up a call and talk to you about the opportunities we have.
Wonderful. Bryce, thank you for sharing all of your knowledge today about Arkansas multifamily, about the market, about these 3 properties that we're working on together, and spending a little bit of time letting the audience get to know you. It's been a blessing. I appreciate you spending time here with us today.
Always a pleasure, Logan. Thanks for the opportunity.
This has been another episode of the Kansas City Commercial Real Estate Market Pulse. And I'm your host, Logan Freeman. Bryce Richardson, Central Arkansas. He is the go-to guy. He is the ARCRE guy in Arkansas, okay? Just like I am the KCCRE guy. He is the ARCRE guy. So thanks for everybody tuning in. We had great listenership. I'm always telling people, please drop more questions in. We love the interactivity of these opportunities for you guys. So thanks for joining in live. We had a high listener rate. I saw during the show that everybody was giving you stars and likes and the little light bulbs down there and LinkedIn. So shout out to LinkedIn for always giving us the platform for us to come here live and continue to grow our businesses. We appreciate you and thank you for always spotlighting our content. All right. Absolutely. So spotlight Bryce's as well. We are here live, Kansas City Commercial Real Estate Market Pulse. I think this was episode 37, season 2, cresting on close to 100, 200 episodes. I can't remember now, but it's our job to try to bring you real-time insights on a regular basis from people actually doing the work, brokering, listing, leasing, selling, buying, multifamily, retail, industrial, data centers, all in the Midwest. So thanks for tuning in. And Bryce, thanks again for being here. We'll be here again live next week.
All right. Thanks, Logan. Until next time.